I noticed something weird this month. My Netflix bill came on the 5th, my phone bill on the 12th, my rent on the 1st. But my dividend payment, still nothing. Just waiting. I checked my brokerage app. Last dividend was 2 months ago, $4.17. And the next one isn't coming for another month. That's when it hit me. My bills are running on a 30-day clock. My dividends are running on a 90-day clock. Something's off. So I started digging. Why do most dividend ETFs pay every 3 months when life happens every 30 days? Is there an actual reason? Or is it just tradition? Turns out the answer surprised me. Most companies pay quarterly because that's when they report earnings. It's an accounting convention, not a financial law. Nothing stops a fund from paying you monthly. And actually, some ETFs do. I found 3 of them. All under $50 per share. All paying every single month. Here's what I discovered. Real quick before we go further. I'm not a financial advisor. I'm just someone curious about money, learning this stuff alongside you. Nothing in this video is financial advice. Treat it as a starting point for your own research, not a recommendation. The first ETF I want to talk about is one I almost scrolled past because of the name. SPHD. Stands for Invesco S&P 500 High Dividend Low Volatility ETF. Long name, boring acronym, easy to miss. But when I looked into how this thing is actually built, I got why people quietly love it. Here's the part that clicked for me. Most dividend funds just grab whatever's paying high yields and call it a day. SPHD does something different. It starts with the S&P 500, the 500 biggest companies in America. Then it filters down to the 75 highest dividend payers. Then, and this is the move, it ranks those 75 by how wild their price swings have been over the past year. And it only keeps the 50 calmest ones. So you're not just getting high yield, you're getting high yield from companies that don't make your portfolio look like a roller coaster. We're talking Altria, Verizon, Pfizer, Kellogg's. Not the stuff that gets posted on Twitter, but the stuff that pays. Because no matter what's happening in the world, people still pay their phone bill. Still fill prescriptions, still buy cereal. SPHD combines a 5% dividend yield with rock-bottom costs, at just 0.30% expense ratio, and pays out every single month, all for around $50 a share. As of May 2026, SPHD trades around $50 a share. Yield is sitting at about 5%, paid out in 12 monthly chunks. Expense ratio is 0.30%. Translation: for every $1,000 you put in, the fund costs you $3 a year to run. That's basically nothing. On a $1,000 investment, you'd get roughly $4 hitting your account every month. Small? Yeah. But it shows up every 30 days. Without you doing anything. Okay, so SPHD is the calm one. What if you want more yield and you're working with a smaller budget? That's where the next one comes in. SDIV, the Global X SuperDividend ETF. And honestly, this one came with a surprise I wasn't expecting. SDIV doesn't just hold American stocks. It pulls in 100 of the highest yielding dividend stocks from around the world. Australia, Brazil, Hong Kong. Wherever the yield is, it's been running this strategy since 2011. So we've got 14 plus years of real-world data to look at. SDIV offers one of the highest yields on this list, at nearly 8.8%, paid monthly, and trades at around $26, making it accessible even on a tight budget, though that high yield comes with trade-offs worth understanding. SDIV trades around $26. The yield is wild. Almost 8.8%, paid monthly. With $100, you can own almost 4 full shares. Turn on dividend reinvestment, and every payment automatically buys more shares, which pay more dividends, which buy more shares. The snowball starts small, but it starts immediately. Now here's where I have to be straight with you. Because when I first saw 8.8% yield, my brain went, wait, what's the catch? There's always a catch. And here it is. SDIV chases yield aggressively. That means the share price itself doesn't really grow over time the way a regular stock might. If you check the chart, the price kind of stays flat, or even drifts down over long periods. Actually, the dividend per share has dropped about 2.6% over the past year, So you're not buying SDIV expecting it to double in value. You're buying it for the cash flow. Period. The other thing I didn't think about at first. Currency risk. Because SDIV holds stocks from all over the world, when those foreign companies pay dividends, the money has to get converted to US dollars. If the dollar gets stronger, your dividends get smaller. It's not catastrophic, but it's a real thing. For some people, 8.8% monthly at $26 a share is worth that risk. For others, not so much. Just know what you're buying. Alright, third one. And this is the one I'm most excited about because it solves a problem I think a lot of us have thought about. Real estate. Have you ever done the math on actually buying a rental property? I did. And I noped out almost immediately. Down payment in most US markets right now, $50,000 to $100,000. Then you've got the mortgage, property taxes, insurance, maintenance, and the part nobody warns you about, the 2 a.m. phone call when the heater dies, and somehow it's now your problem. So I went looking for a way to get the real estate income without the real estate headache. And I found SRET, the Global X SuperDividend, REIT ETF. Quick explainer on REITs because this is actually pretty cool. REITs, real estate investment trusts, have a special deal with the IRS. They pay zero corporate income tax. But the catch is, by law, they have to pay out at least 90% of their taxable income directly to shareholders, which means, SRET takes that idea and bundles 30 of the highest yielding REITs in the world into one ticker. SRET is the most accessible entry point on this list, trading at around $22.72, with an 8% monthly yield that gives you real estate income without a single mortgage application or maintenance call. SRET trades around $22.72. That's the cheapest pick on this list. Yield sits at roughly 8%, paid monthly. Think about the contrast for a second. To buy real estate the old way, you need 6 figures and a 30-year mortgage commitment. To buy SRET, you need $23 and a brokerage account. And here's the kicker. If you ever need your money back, you sell it in seconds. Try selling a kitchen in seconds. Doesn't work. But, and I learnt this the hard way reading the tax rules, there's a catch with REITs that almost no one talks about up front. REIT dividends get taxed as ordinary income, not the lower qualified dividend rate. That means whatever tax bracket you're in, that's the rate that hits your SRET dividends. The workaround I found, and this changes everything, is to hold SRET inside a Roth IRA if you can. Inside a Roth, dividends grow tax-free and come out tax-free. The IRS literally cannot touch it. If you're in a regular taxable account, just plan ahead. Set aside maybe 20 to 25% of your dividend payments for tax season. Don't let April surprise you. So how do these 3 ETFs actually work together? Because the worst thing you can do is throw everything at the highest yield and pray. I'm not building a portfolio for you. I can't do that. But I can share how I'd think about combining these 3 if I were starting today with, say, $1,000. A sample $1,000 allocation splits 50% into SPHD as the stable core, 30% into SDIV for global high-yield exposure, and 20% into SRET for real estate income, balancing yield against risk across. Roughly half into SPHD as the foundation, that's the calm anchor. About 30% into SDIV for the higher yield and global diversification, and 20% into SRET for real estate exposure, but keeping it the smallest position because it's the most volatile of the 3. This isn't about getting rich next month. It's about getting paid every month. Slowly, consistently, predictably. Maybe in month 1 you only see $5 hit your account. But that $5 becomes $10 the next year. Then $20. Then it covers your Spotify. Then your Netflix. Then your phone bill. The income compounds. The habit compounds. That's the discovery here. One more reality check before I sign off. Yields move. The numbers I shared today are accurate as of May 2026, but they will change. SDIV's dividend has actually been shrinking. SRET only holds 30 REITs, which means more concentration risk than a broad REIT fund. None of these are perfect. They're tools. Use them with your eyes open. I'm genuinely curious which one of these caught your attention. Are you the calm SPHD type, the high-yield SDIV explorer, or the real estate SRET person who just wants to own buildings without the 2 a.m. calls? Drop it in the comments. What you share helps me figure out what to dig into next. And if you got value out of this, subscribe so you don't miss the next discovery. I'm not a financial expert. I'm just someone curious about money, sharing what I find. Learning money together. See you in the next one.